Well, thank you everyone for tuning in to this week's Mortgage Matters with Chris. Thank you for being here with us, Chris. You have over 25 years
Yeah.
in the mortgage and banking industry. They kind of go hand in hand there. You've seen the side as a broker, you've seen the side as a banker, and you've even seen the side, from the real estate side. You and your wife do this together, and she has just about as much time in the industry as you. So we are thankful for your knowledge today as we're jumping into this. So, Chris, last week when we were here, we had a different topic we were talking about, and we let everyone know that we were going to
Mhm.
be talking about the big headlines of the bank failures this week. Um,
Yes.
I think it was a really good decision for us to wait a week to talk about it because there are a lot of people who came out right as soon as it happened that Monday of last week, and they got it wrong, and they spread a
Yeah.
lot of misinformation. So, one of my favorite things to do is to go beyond the headlines and pull back the veil and show people what's actually going on. Because where there is knowledge, there is power and there is more trust and less fear.
Yeah.
So, obviously, topic we're digging into today is these bank failures that happened that we saw over last week, and kind of pouring into this week a little bit. So, Chris, can you start us out by giving us the high level view of what happened? I know
Yeah.
that is a easier said than done. So, good luck. I'm going to pass that over to you.
I've been looking at this, for the last couple of days on how to communicate this in a way that's people can wrap their head around it because it's, all you think about for everybody out there, even myself, is, oh my word, is my money at risk in the bank? Um, what happens if all these banks shut down? What happens to my money? Well, and that's kind of what happened here with the SVB, that bank, with their collapse. And I'm going to just walk you through a few things on kind of how did that happen. And there's many of these mid-sized banks and smaller banks that are going to go through some turbulent times, but there's a solution at the end of it. So I'm going to say that they're going to go through some turbulent times because as we all know, it was just announced yesterday that the Feds raised the rates again, 0.25%. However, before this all happened with this bank uh, debacle, they were actually going to raise it 0.5%, and because of what happened, they only raised it 0.25%, and that affects a lot of different things. It actually helped us in the mortgage business because if it would have went higher, our rates would have went up, and we've actually had a little bit of a dip because of that. So I'm going to talk about what happened with the bank, right? One, two, how did they get to where they got, and why did it happen, and how that increase of the Fed fund rate had a part to play in it, and as well as the bond market prices increases, how that had something to do with it as well, and kind of tie it up in a bow to where hopefully you at least have a better understanding on what happened and more confidence that one, you don't worry about your money in a sense, or, lose sleep every night and put yourself in angst. And if you're renting and you are looking to buy a house or maybe sell a house and buy another house, worried that it may affect the housing market as it stands. These are the things that we'll debunk and kind of unpack, if you will, on this call. So we're so excited to talk about this, right? I'm going to try to get all amped up for it. It's hard to get amped up for. So why did this collapse happen? I mean, that's the big question. So, you had this crazy 48 hours. You had the customers of the SVP yanking their money out. A lot of their customers were tech companies, new companies, and they just started. It was a classic run where the bank it was a house of cards came tumbling down. But a huge root of the demise, really, you can go back a couple of years ago. And like many other banks, a lot of banks, the SVB, they put billions of dollars into U.S. government bonds, where they were at zero interest rates. So they bought all these bonds and these assets at that 0% interest rate. So when things happen, they would have some collateral to work with. And it seemed like a really good bet at the time, right, for these banks to be betting on that. Most people didn't see the insight. They didn't see that the Fed was going to increase, as much as they have over the past few years. They didn't think that this was going to happen. Their borrowing power was going to be hammered. So it didn't get unstuck. So once the Federal Reserve hiked these interest rates, it aggressively, so they could tame this inflation issue that we have. It affected everybody. So when the interest rates rose, the bond prices fell. So a lot of these banks' liquidity went down. So you have a perfect storm. Okay. So what typically happens is banks take in deposits, right? So like this bank, they take in deposits and they use them to make loans. The difference between the interest on the loans and the interest that's paid to depositors is a net interest margin. So that's the money that they make. The difference between the assets, now I'm kind of talking a little over, and the liabilities is what the bank's equity is. So the bank has equities based on the assets that they bought, and then based on the money that they're deposited and they're lending that money out, that is where we get some net interest margins. So to generate a positive net interest margin, okay, banks make long-term loans at higher interest rates than what they pay on the deposits. As many of us know, if you put your money in the savings bank, you're not making a lot of money on it though, right? So the bank has all this money, people, millions and millions, and in some cases, billions of dollars here that they're lending out at high interest rates, and they're paying out very little on the other end of it. So that's kind of how banks work. So you understand the bank math, deposits in to make loans out. And then they also have assets and other liabilities that help them they can borrow against or pay off so they can have some standing.
And
right?
this is regulated by the federal government. So there are rules that the federal government has set up that says banks have to have so much in reserves in order to exist or to be in good standing.
Correct. So now let's walk back. Okay. Now let's go back to what we said, right? So when the interest rates, the bond prices fell, and that eroded the value of all these bonds that the bank had, the bond portfolio. So the bond portfolio is probably yielding somewhere around 1.8, somewhere like that, return last week, but it was far below what that 10-year treasury yield was when it was around the 3.9%. And that was reported through Reuters. If you want to look it up, or you want to go really deep into it, you can kind of see what happened. But at the same time, this is the issue where it comes in. At the same time, the interest that the Feds were increasing and hiking the rates out, this sent the people, the borrowers, the bank customers, their costs began to get higher and higher and higher. So meaning all these startup companies had to channel more cash to repay their debts because the price of everything's going up. And at the same time, they're struggling because of the economy's tough to go raise out more money because everybody's getting affected by this. So we're all doing the same thing. So what happened is that forces these businesses and all these different companies to take out of their deposits that the bank held for them to fund whatever growth that they were going to do. So whatever they were going to do to grow. And what happened was now the bank was losing it. So that now you go, and that sparks what this bank run happened in their investment decisions. So I think they sold off. I guess some notes here. I'm gonna just take a peek at. Yeah. They had to pay out all the money that was coming out. They had to keep up and pay these people back the money that was coming out. So the lenders, I think, what happened is they sold out a bunch of their securities at a huge loss, which then affected this perfect storm to where they were plummeting. So the bank stock plummeted like 60%. And all this happened because of this perfect storm. So if we go back to the points, let me just tell you, at the bank, the math of the bank was the SVB held about $212 billion of assets against $200 billion of liabilities. So at the time, in the beginning, they had a cushion. So if you understand this, 212 billion of assets against 200 of loans that were outstanding, left about $12 billion extra, which represents about 5.6% of their assets. So the assets that they have fall into these three buckets. So they have the mortgage-backed securities, which in their case, they had about, I think it was like $82 billion, right? So 82 billion. No, you got 200 billion in liability, right? And your assets are 212. So you had 82 billion in mortgage-backed securities. Then you had loans out, okay, at 74 billion. So that was 55%. 55% of them were short-term loans to venture capitalists and private equity firms, okay? And the third is you had liquid assets of 55 billion, okay? So you had those are your three buckets, your asset buckets, okay? And then the liabilities, they fall into two buckets. You have deposits of 174 billion. So only out of that 174 billion, because of the rule of the 250,000, only 11% of that is FDIC insured, okay? And then you have other debt, 25 billion. So that's your scenario. So what happened with this bank is the Fed interest rates increased, which caused long-term debt to decline in value, right? So the prices moves inverse to the yield, and you have that going on at once. And the accounting rules, what happens is that it allows the banks to book the mortgage securities as held to their maturity. It's ATM, if you want to look it up, to avoid to hit their book of equity. So the good thing is, if nothing's sold, there is actually no loss to record, right? But in their case, when you have people pulling out their money, they have to. So my note here.
So let's talk about that, people pulling out their money. So, because that's a really important point. This didn't happen overnight.
Correct.
Like, no one woke up Monday morning, or I guess it was Friday morning technically, and was like, oh, my bank's getting shut down.
Correct.
They, in this case with Silicon Valley Bank, they had a warning coming down the pipeline from the California regulators. And that's how the depositors, meaning the customers, the everyday customers of the bank, knew. And that's why I wouldn't call it a panic, because I might panic myself too. So I'm not gonna blame them. But that's why they rushed to the bank, like what you're saying right now.
Well, if I know I'm a business owner and I have $2, $3, $4, $5 million in the bank, and I know that the FDIC is only going to insure 250,000 of it, what do you think I'm going to do if I hear rumors that this bank has troubles? Well, I was sitting in a meeting the other day. I'm in a networking group in a local bank. I'm not going to name the bank, but she was sitting in there, and she said there was a huge family locally to where we are that heard about these mid to small cap banks were hurt because of this. And they went out collectively as a family, and they took out their deposits, or a big chunk of them anyways, not the whole thing, but it accounted for a lot of money. I think she may even said millions between the whole family. And they moved it to a bigger bank to protect it.
And that was a bank that, I mean, they had nothing to do with this. So, Chris, this kind of goes into the next question here that we've heard a lot from your clients, past clients and such. Is this isolated? Like, how big is this? Is the whole banking industry collapsing as we know it? Because that's what we've heard, right? Can you address that?
No, I don't. It's not crashing. It's definitely going to be, it's definitely not going to be easy at a time. But I believe, I have something here is that, the federal government's going to step in and help insure some of these banks and these issues, or these people that have their deposit in, so they're not worried about losing and only getting the 250,000. They're going to insure up to more of it if there's a problem.
An overwhelming majority, I mean, majority of people that have money in the bank fit under that 250,000 insured. I remember when I was in high school, I used to be a bank teller, and we had one of those old-fashioned plaques that sat on the window of the bank, and it said FDIC insured 250,000. And I remember that in my small town, because I remember there was one client in particular who had more money than that. Not that there was ever like going to be an issue at my small town, but I remember thinking, "Ooh, that's risky." So there's a risk portion of it that doesn't affect majority of us. You know, you had talked about in terms of the assets and liabilities that Silicon Valley Bank had, and that a large portion of that was venture capitalism investment. And we won't bore anyone's ears off with venture capitalism, but I think what people need to know is that venture capitalist investors know that that is a risky investment. And the many of the investors who lost out or supposedly will be losing out in this are people who knew that they were putting their investments, their high dollar investments, in something that is risky. Again, doesn't affect most of your everyday common man.
Correct. I think what ended up happening, I believe it was Wednesday on March 8th, the bank announced that it was selling off about 21 billion of its liquid assets at a 9% loss, and they would raise money to cover the loss. But, what do you think if you're one of the investors? This bank, has investors, it concerned them because
Yeah.
the losses and expected to deteriorate even more. So you had all this perfect, and I think your question was, to circle back, is, banks. These smaller cap banks. They're gonna. I think we need to get the confidence back in the depositors to say, listen, we're gonna go through this. You're not gonna sit there and lose your money. So don't go pulling out your banks and burying some of these banks. But one thing that I read recently too was banks go through this crash in a sense every 10 years. And if you think about it, it we had a little bit of extra time because the last time it happened was '08.
Mm-hmm.
So it was so bad in '08 that it's kind of, we were due. We were overdue for the correction that's going on right now. So if you look back historically, every 10 years, the banking system kind of goes through something.
Well, Chris,
So
you were in '08, you were at that point a veteran banker, a veteran mortgage lender. Can you compare to us, from '08 to today? Like, what's the comparison there?
well, it's a completely different market. So the recession, if you will, that we had in, the late end of '07 going into '08, '09 was brought on from the housing market. So the housing market caused it, right? You had this over surplus of homes on the market. People were overextended on their credit, and that's what caused it. That's what caused the recession we had. Whereas this market has nothing to do with it. As a matter of fact, real estate prices haven't dropped all that much. There's been a correction because of how high they increased, but it has nothing to do with, people have a ton of equity in their homes right now. I think the average household has 30% equity or somewhere around there. Don't quote me on it, look it up, but I think it's 30% was the last time I checked. So you went from having zero equity to 30% now, which is completely different. People don't walk away from that kind of equity. Unemployment in '08 was at its worst. Unemployment is relatively low compared to what it was in '08. So, you have a recession that was caused by two different things. And one was being real estate, which this one, and most recessions that we've had in the history have never been real estate other than '08. So you have a lot of people comparing the two, but there's really no comparison at all in that. And typically, when we go into a recession, our rates go down and the housing market usually does better.
Yeah.
When the feds increase their rates, sometimes our rates will go up. That's why they didn't go. They actually went down because of the increase was only 0.25% rather than the expected 0.5%.
Yeah.
So I think to kind of tie this up into a little bow for all of you out there, a lot of these small to mid-sized bank, they, in this case, it was big. A lot of tech companies that were in it, they started pulling all their deposits. They had to borrow against at a loss. And the crazy thing is that a lot of the banks that are out there right now, um, you know, this bank had a negative $1 billion balance, and that's when the FTC took over it on Friday. And again, FDIC, the federal government has announced that they were going to protect those depositors above and beyond right now, just through this stormy time. So I think to kind of put this into a nutshell and say, yes, it's not a good thing what happened here, but it's not something for people to go run out and pull out all their money out of the bank.
Chris, what would you say to your clients right now, recent home buyers who bought a home with a mortgage from you? Because I know that you fielded a lot of questions from them and helped, calm a lot of fears. What would you say to those people?
I would say, again, with the housing market being so low, we're undersupplied right now with homes. Rates are still not, they're not horrible if you look at the historical average of interest rates. I mean, right now we're looking, I was quoting somewhere in the sixes. I don't want to, every rate is different for everybody because it's graded based upon income, based upon FICO, credit scores, and all this stuff. But the rates were relatively much lower than they were prior to this incident with the bank. So, again, rents are still going up, increasing at the highest rates of all time right now. So if you're renting and you're thinking, or you've been sitting on the sideline to buy, I would encourage you to still move forward with it, because, you're still paying for someone else's investment, and you're paying someone else's mortgage. A, if you're renting. Two, you're securing your price by buying. And this event that happened, as unfortunate as it was, actually had a positive effect in a sense, which is nothing positive about it, but on our interest rates going forward. So it slowed the Fed from continuing to rise those interest rates, which then leveled it out and helped us drop in rates. So if you're in the market, not sitting here as a salesperson or anything like that, you have to live somewhere. You might as well fix your payment, right? And know what you're going to pay for the next 30 years. Properties historically in seasons like this have always appreciated. I think you're going to continue to see homes appreciate over the years, just because of the low demand, right? I mean, the high demand and little supply. We're in a low supply market. So it's like anything else. If you have high demand, low supply, it drives prices up. So you're going to continue to see that. It's been corrected over the last pretty much year. We've seen the correction in price. Maybe there's a little bit more. Maybe there's a little more to go. Certain markets, it's continuing to rise. So
it's still a good time to secure your future by securing that mortgage.
I believe so.
Payment. Yeah.
For a lot of different reasons, tax reasons. I mean, if you're renting, you don't get to write off mortgage interest. There's a lot of benefits to owning a home. I would encourage you all, if you have more questions, reach out to me. I can go in a deeper dive. I hope this was a high enough level to where we could all wrap our heads around it, because I know it's a pretty heavy subject. But also, if you have any questions, give us a call. We just want to be your resource for information, if you will. That's what we're here for. And I really appreciate, Mindy, you quarterbacking this with me.
Yeah. Well, Chris, thank you for this. Thank you for, again, pulling back that veil, and thank you for calming a lot of the fears that I know people locally and nationwide have had watching this go down. Because exactly as you said it, we haven't seen this in almost 15 years. So it's like, what's happening? So, yeah. Well, we'll be back next week for the next episode.
So just as I close this, right? So, I mean, these banks that are in this trouble, they're going to be allowed to borrow money straight from the Fed in order to cover any potential rush of customer withdrawals. And by doing that, they're going to be doing it without being forced into the type of money or losing money on any of their bond sales that would threaten their financial stability. So, I mean, that's the key piece of it, that, yeah, banks may be in trouble, but they got a safety net behind them, right? And it's going to help us. So there's already an emergency lending program in place, so that this isn't going to perpetuate and grow and go into a mass mayhem, if you will. So I just want to make sure I'm clear on that. So I didn't really get too clear on that in this, but hopefully that answers that question in case it was lingering. So we can add on that. Sorry, been
That's okay. We're not reliving the Roaring 20s
uh,
and the 30s, so
or
that,
the 08. So
or the 08s. So, anyways, thank you everyone for tuning in to this. We'll be back with another topic next week. And as always, don't forget, if you missed this live, you can always catch this on your favorite podcast platform. Don't forget to like and subscribe there. And we have this also on YouTube. The real YouTube videos have really, really done well lately. So if you catch us on YouTube, don't forget to like and subscribe there and help us out on that. So I hope everyone has a wonderful weekend, and we'll be back next week.
all right. Thank you guys. Thank you, Bendy.
Bye-bye.
Bye now.